Shopify has been in the news recently, all for the good reasons. They had a fabulous 2020 and a Q1, a good start to Q1 in 2021. And this is my second attempt to value this stock based on DCF valuation. Greetings, viewers. You're watching Aman Sangha, independent financial advisor in Mississauga, Ontario. As I get started into this, I just want to say that this is not intended to act as an investment advice to either buy or sell a security. These are just my opinions, which have been formulated using the coursework, the methodology, and some of the tools that are shared by Professor Damodran on his website. To get started, I'll go into the backdrop of Shopify. If you don't know that already, it provides a web front solution to small and medium business enterprises. So basically, if you want to go online, there is a platform for you to do that through Shopify. So really, it doesn't really have a direct competitor in the market. The only direct competitor is BigCommerce, which went public last year. But in terms of the established players, there's not a direct competition out there. So what I've used as my data set is other companies, more in the mid to large cap space, which have offerings which have enterprise offerings for their clients. And there are some smaller names like Connexus, but there are fairly big names like Intuit, Adobe, Salesforce, SAP, and Oracle. So there is a lot of companies out there, not exactly doing exactly the same thing as Shopify, but I've used this as a benchmark as a framework to use some of the numbers to justify or come up with future growth projections. Just off the gate, you can tell that for a revenue that's just shy of $3.5 billion, Shopify has a market cap which seems more aligned to the well-established players than the some of the smaller players who are probably about who are probably less than half of Shopify's market valuation. So anyway, with that, I kind of have used Oracle as a guiding principle that it's the about the 40 billion annual revenues is what I've used as my final target for to calculate the terminal value. Some of the EBIT margins are based on an average of these numbers. I've used a 25% number. And then the part I do want to mention is that these are unadjusted numbers. These are available on Yahoo Finance. So the actual numbers, the adjusted numbers look a bit different, but I've still used these as a benchmark to lay some milestones for a future DCF valuation. With that, let's get started into what Shopify looks like right now. So this valuation was done on May 19th. So currently they had a revenue just shy of this is trailing 12 months. And then adjusted margins, but the adjustments by mean R&D and lease, it comes to about 19%. With that, if I put in the non-operating losses, which are the carry forward losses, that's the starting point we have. And before we get there, the other part I want to mention is for my analysis, I've used there are significant changes from last August. So the significant being the risk-free rate has jumped up from 0.71 to 1.63%. The enterprise risk premium that I've used for Shopify is based on the geographical spread of their revenues. This has been calculated. The beta is what the number I have used exactly from Yahoo Finance. I haven't built up the beta myself. And I have assumed a triple A rating more in context with the kind of rates they were able to get on their convertible offering that they went to market last year. And lastly, assumed a fairly high investment in growth over the next 10 years, so sales to capital ratio of 1. So this to me is optimistic. I mean, Oracle is probably half of that number, but some of the smaller names that I shared on my previous slide are about there. So they would need a significant investment to be able to scale up to that kind of revenue. With that, the next step is to calculate the cost of capital. The capital is primarily equity with a little bit of debt in there, and most of it was last year, which is a convertible note through a convertible note. And that's the starting point of my analysis. Now, building forward where we are, so as I said, I have assumed that Shopify would be able to invest in the future growth. I'm assuming that they are able to grow at about 40% of the gate, and in the time terminal year, which is after year 10, I'm assuming a growth at a risk-free rate, and the current margins would improve from currently to what's about 25%. With that, if I play in the numbers, this is what the numbers look like. I've used Professor Damodharan's spreadsheet to calculate these numbers projected ahead. And if you look at the terminal value, I've assumed future growth at perpetuity of the current risk-free rate of 1.63%, a stable operating margin of 25%, and the cost of capital I've assumed as the risk-free rate and 4.5%. With that, if we were to do all that calculation and summarize it as to what it would mean in today's dollar terms, we bring it down to today's dollar, discounting the cost of capital that we've used. You can see that it's about 54 billion. There is cash on the balance sheet, and they've made investments in other companies that went public, so which has played well for them in the last few months. And then we take out the debt. We come up with the value of equity. We subtract the equity options, and then divide by the number of shares outstanding. And lo and behold, this is the number that I come up with. So I'm calculating based on this a share price, which is around the ballpark of $490. The stock on May 19th, when I did this analysis, was trading was around 1170. So in summary, I think my thesis hasn't changed from what it was last year. Shopify, in my mind, is about the stock is currently about 40%. From a valuation perspective, it will probably coming out at a 40% of where it's currently trading at. I will continue to revisit my analysis and my scenario. I'll be doing it again in the fall to see if there is a difference in numbers and if there are any alterations that need to make. In summary, my conclusion, I think the stock is overvalued. If there is any change in assumptions that you think I could incorporate into my calculations, kindly leave them in your notes below. And with that, I want to say thank you so much for watching. Bye for now, and we'll be back soon.